Hello everyone, this is Xavier Crowley, and on behalf of UNSW Economic Society, we welcome everybody to Term 3. And to kick it off, what better to have than the Week 0 market recap, covering the latest macro events in the ANZ region. This week, we have current news for COVID, monetary policy, Australia-China relations, and more. As a quick COVID update, Melbourne, Sydney, and New Zealand are currently in lockdown, despite New Zealand easing some restrictions over the past week as they retain control of the Delta spread. Also this past week announced was a reopening roadmap for Sydney. Once the state reaches 70% full vaccination, expected around mid-October, gyms, hairdressers, and hospitality venues can reopen at reduced capacity, and domestic travel will be allowed. Some parts of regional New South Wales exited lockdowns this past Friday, and restrictions will ease further once 80% fully vaccination is achieved in November, which will entail the resumption of international travel for vaccinated individuals. This is crucial for the recovery of the economy, as underemployment creeps higher in the previous few months and to rebound from the expected GDP contraction in the September quarter. Now, onto some monetary policy musings. The RBA's September policy statement made the shockingly uncontroversial acknowledgement that Australia's recovery had been interrupted by the Delta outbreak and associated lockdowns, but expects the setback to only be temporary as vaccination rates increase and restrictions ease. With this sort of analysis, I could be the head of the RBA. More meaningfully, cash rates have been held at 0.1%, and the RBA will remain slow to taper unconventional monetary policy relative to its international peers, confirming a $4 billion weekly purchase rate until at least mid-February 2022, and continue to review asset purchases in light of economic conditions and the health situation. On to some light-hearted Australia-China diplomatic issues. Treasurer Josh Frydenberg delivered a speech early last week targeting China's growing assertiveness. He will urge businesses to strengthen their resilience and develop more secure supply chains in the increasing economic coercion from China. He called upon companies to work harder in diversifying away from the China market, pointing to the success of firms that were targeted by China managing to find new buyers for their goods and limiting the economic damage of Beijing's trade war, as we covered in the market update a couple of months ago. A little bit later in the week, comments surfaced from a Chinese government spokesman who said Australia had been playing the victim over its relationship with Beijing and was in fact bullying China. The label of so-called economic coercion can never be pinned onto China, said the Foreign Ministry spokesman. Instead, Australia had been ganging up, presumably with some kangaroos, to pressure China and harm China's core interests, conveniently forgetting the size of China's economy in comparison to Australia. Back home, there have been some talks between Morrison government ministers over whether to scrap Chinese company Landbridge's 99-year lease of the Port of Darwin. While sources say a Department of Defense review of the lease is likely to find it should be scrapped, there is concern doing so will worsen tensions with China and bring about another World Trade Organization challenge. And to end the week, China is now lobbying the Australian government for help in joining the CPTPP Regional Trade Pact. China has reached out to Australia by pointing out that their economies are highly complementary with enormous potential, as well as touting their 2015 trade deal. I'll keep it real, it seems like a toxic relationship, but we'll have to see how the relations continue to play out over the next few months and years. Now onto a rapid fire round. ASX 100 companies have accumulated $66.4 billion of franking credits, with $27.2 billion added since the beginning of the pandemic in early 2020. The surge in franking credits has been driven by record-breaking rally in iron ore prices and the capital return restrictions on banks put in place by APRA last year. The big iron ore miners built up an additional $19.2 billion of franking credits since FY19, while the big four banks and Macquarie accumulated $5.5 billion. Websites of a number of New Zealand financial institutions, including ANZ and the country's national post services, were briefly down last Wednesday. Officials from the country's computer emergency response team said they were battling a cyber attack from an unknown source. Selling of iron ore comes amid Chinese efforts to cool steel production as part of Beijing's environmental drive ahead of the Winter Olympics. Steel production has fallen sharply in July and August in response to regulatory directives, which may continue until March 2022. Regulators are also moving to tame speculative activities in the commodities markets, with the Dalian exchange raising transaction fees on coal futures. And there was no important data this past week. That's all, folks. Have a great week.